How will the 2024 tax bracket changes impact your decisions as a long-term investor? For most of us, taxes will be the single largest expense we pay over our lifetime. So it's important that we understand how the tax systems work. In today's video, we're going to be talking about the 2024 bracket changes. We're going to be talking about the progressive nature of the tax system. We're going to discuss, as investors, how should we think about the difference between the types of taxes that we might incur, and then looking forward, what might taxes do in the future, and how can that impact our decisions today? Okay, so let's get started. First off, we are going to be looking at the 2024 tax changes, and we're going to start with ordinary income, then you get into capital gains, and then go to the standard deduction. So let's kick off with a few charts here and get going. So chart number one that we're going to look at, this is for ordinary income. Now, tax rates across the board, or the bracket changes across the board, have gone up about 5%, which means your income threshold moves up 5% before you go to the next bracket, which is good news for any wage earner, for any investor, because it means you can generate more income before moving up a tax bracket. But let's look at the big changes. And so for ordinary income, this chart here is going to show us at the top level at 37%, which has not changed. So this is an important distinction. The brackets have not changed at all, but the amounts in the brackets have increased. So you can make more money before you move up a bracket. So that's the primary change in the 2024 tax changes. Okay, so all the way to the bottom. Now, this chart shows for single, married, and head of household. I'm just going to speak to married because it's easier and makes for a shorter video. And so let's talk about married. So what this means is you have a 10% tax bracket from $0 to $23,000, all the way up to, at the top right, you have a 37% tax bracket for anything over $731,000. Now, I think a lot of people, they hear about the top tax brackets, but they don't realize how much income you have to generate in order to be able to get into those top tax brackets. And so where does this land relative to last year? It's about a 5% increase for these numbers, right? The brackets are the same, but the numbers have all increased about 5%. And so that's ordinary income. So what about capital gains? So ordinary income is going to be, what you might earn from your job, if you own taxable bonds. Capital gains is going to be qualified dividends and assets that you've held and have appreciated and owned over a year. And so for capital gains, let's look at the capital gains chart. And what we've got here is, again, an increase of about 5%. But here, what we've got is from 0 to 94,000, you're actually in the 0% tax bracket. From 94,000 to 583, you're in the 15% tax bracket, and then anything over 583,000, you're paying 20% in taxes. And so again, the brackets are the same, 0, 15, and 20. You're just able to have slightly higher capital gains and dividend income in these brackets before you get bumped up. And so what about the standard deduction? So the standard deduction is the deduction that you're allowed to take without having to itemize anything. And so the standard deduction was increased several years ago, which was good news for a lot of people, but it also meant the value of your itemized deductions went down or away because most people end up in the standard deduction zone. And that has also gone up. For single, it's $14,600. For married, it's over $29,000. And for head of household, it's around $22,000 or just under. And so that is the automatic deduction you will get. If you have no deductions at all, you get to take the standard deduction. So that has gone up. And so those are the primary changes, which is the brackets have stayed the same, but the numbers have gone up about 5%. One thing to be discussing here. So that is the changes. So they've gone up about 5%. But what's really important is to understand, how do the tax brackets work in the first place? And when we're talking about the tax system, the U.S. tax system, this is a progressive tax system, which means when you hear about things like your marginal tax. So what does that mean? Well, let's go back to this ordinary income brackets here. And again, we'll just use married, but let's look at this here. So what this means, so you see 10 all the way up to 37. And I'm just going to put somebody right in the middle for round numbers so we can understand how this works in both directions. But let's say somebody has an ordinary income of $250,000. Okay, so they're doing great. They have an ordinary income of $250,000. So where does that put us? Well, if they're married, that puts us right here between $200,000 and $383,000. Okay, great. Let's move over to the left. That means their tax rate is 24%. And so what sometimes we might think is, well, let's take $250,000, multiply it times 24%, and that's how much taxes they pay. Except that's not how the US tax system works. And so since it's progressive, what that means is your first 0 to 23,000 is taxed at 10%. Then between 23 and 94,000, you're taxed at 12%. Between 94,000 and 200,000, you're taxed at 22, and only the amount over 201,000, between 201 and in this case 250,000 as an example, are they paying that 24%. And so for quite a bit of their income, they're paying substantially less than 24%. And that's with ordinary income. How does it work with capital gains? Capital gains, it's the same story, and I think even more compelling. So let's look here. Again, married, if you have capital gains under $94,000, right, and no other income, then you will be paying 0% on your capital gains. So if your income is under $94,000, including capital gains, you're paying 0% on those gains, which is pretty powerful. And then if you make, just call it a very large number, $600,000, well, you're not paying 20% on everything, right? For most of those gains, you're paying 15%. For a portion, you might be paying 0%. And then for only a little bit of it is you're paying the 20%. And so understanding how the tax system works in a marginal component, which means only the dollars above the bracket are where you're paying those rates. And so you can apply, going back to the ordinary income, you can look at what your income is going to be, put it in whichever of these boxes that it lands, and realizes your marginal bracket that you might hear is over to the left, but that's just what you pay on the next dollar that you make and anything above these numbers right here, okay, over on the left side. And so the number that you hear, the tax bracket that you're in, is not the total amount that you pay. That's just what you're paying on your highest earning dollars. Keep in mind, you're paying a much lower rate on some of these other dollars. So we've talked about how the tax system works. We've talked about the 2024 changes. What does this mean for long-term investors? Why should we care? Well, one of the reasons that we should think more about our taxes is when you go back and you compare the ordinary income rates and the capital gains rates, what you can see is there's a very big difference between making $1 at the highest ordinary income rate and $1 at the highest capital gains rate. And not just the highest rate, everything in between. The capital gains rate is going to be a much more efficient way to incur taxes than the ordinary income rate. And so how does that help us as investors? Well, different things, different types of investments are categorized differently from an investment standpoint. And I'll give you some examples. So if you own a corporate bond or a treasury bond, you will be incurring the income that they're generating at the ordinary income rate. And so we can go back to that grid that we've discussed. And so any income you're generating is going to tack on to your highest rate and going to be taxed at that marginal tax rate. So we think, okay, well, how do capital gains work? Well, capital gains, which can be qualified dividends from companies or can be assets that are appreciated, gone up in value, and sold after a year, so long-term capital gains, are generating a much lower tax burden. And so when you look here, again, 0, 15, and 20% is much lower than 10 all the way up to 37%. And when you're thinking about your investment strategy, be thinking about, if I'm generating income and I'm going to be paying some of these higher rates, is it worth it? Are there ways that I can generate long-term capital gains with a lower tax rate to where I have more take-home money? Because the only money that you can spend is the money that you have available after taxes. And so as long-term investors, we should be considering, is my portfolio thinking about the tax liabilities that allow me to have the most after-tax dollars I can to support my retirement and my future goals? Okay, so those are the implications for long-term investors as far as the difference between ordinary income, which can get pretty high, and long-term capital gains, which can be an efficient way to pay taxes. And so we might be thinking, well, I'd really like to defer taxes for as long as I can. I don't want to be paying them today. We should defer. We should pay these later, which I see as a common strategy, which I think can end up fine. But let's discuss the other side of that, which is when you are deferring taxes and you are not paying today, they're not going away. We're just kicking the can down the road to pay later. And when might it make sense to pay taxes later? Well, if your tax rate might be the same or it's going to be lower. But what if tax rates are higher? And I think for many of us, we look at the tax numbers and we say, I'm already paying too much in taxes. I don't see tax rates being higher. But let's look at history and see what have tax rates done in the past relative to today. So this chart here is going to go back quite a long time. So as far as the numbers go, it's going to go back over 100 years. But just since the late 30s, what you can see is these numbers, this top marginal tax bracket, which is this red line. Now these black dots, by the way, this can look a little confusing. These black dots are all the different levels of marginal tax brackets. So if you look over to today on the far right, we actually have a relatively simple system. There's not that many levels in the tax brackets, right? Versus if you go back a few decades, what you can see is there were many more levels, and so it was more complicated. But even more importantly, the more complicated, the top tax rates were dramatically higher, getting up into the 90s. So what that meant is every dollar that you made, or more than 90% went to taxes, which is not that incentivizing, of course, to generate income. That's another discussion. But the point is, in looking at these tax brackets over the last several decades, and then looking at where we are today, there have been extended periods of time where taxes have gone dramatically higher than they are today. And so if we look where we are with the economy, with the government that's printing money, there's typically one primary way that the government comes to collect. Once they've started generating money and debt, they have to raise taxes, which would not be a surprise for, I think, anyone if they came out and said, hey, tax rates are going to need to go up from all this money that's been printed. That's just the way that things would go. Okay, so in this video, we've looked at the 2024 tax changes. We've looked at how tax brackets work. We've talked about the implications for long-term investors, and then we've looked back to help us look ahead and say, how should we think about the future of tax brackets and what does it mean for us today? More importantly, we should be looking at taxes as not just a number, but as a framework for making better financial decisions about the future. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.